Good everyone. Thank you for joining us for today's episode of What the Options Markets Reveal. Before we get started, please take a look at the shared screen and be aware that neither Market Chameleon, Dimitri, myself, Felix, Options Geek, our registered investment advisors, or a broker dealer, that this show is for informational purposes only, and that all that's discussed is, again, not investment advice, but for your informational purposes only. Thank you for joining us for the first episode. And we are pleasantly surprised to have two option experts on the show today. Felix Frey from Options Geek and Market Chameleon's own Dimitri Pargamonic. And they will be discussing the ins and outs of this GME trade that's traded probably for 2 weeks now. It involves a lot of options, a lot of stocks, a lot of speculation, characters from Wall Street Bets. It's very interesting dynamic in the marketplace. And what everyone should know is that the options market will reveal things that just the stock may not. So today we'll dive deep into the options. And with that, welcome Felix and Dimitri.
Hey, well, thanks for that.
Hey,
Thank you, Will.
Feels.
you're welcome. Welcome, guys. So
So,
Felix, why don't you get started telling us a little bit about what you know about this GME
sure.
situation and maybe what's going on in the options, what's actually going on in general with GME and the characters involved?
Yeah, I think it's a fascinating story. It's a continuation, obviously, of 2021. Um, the Roaring Kitty pops up and all of a sudden things get crazy again. The interesting part is really there's a couple of parts here to the story, right? There was this initial part that where there was unusual options activity popping up in late April, early May, right before the first spike. And that part's interesting, right? There's questions about how do you find those trades before they happen, right? The stock was trading around 10 and then it spikes and then it comes off, then it spikes again. So how does that happen, right?
Yeah,
How can you get in front of it?
Roaring Kitty actually revealed, right? That was the deal. He revealed his position
Right.
on Wall Street Bets or YouTube. I forget where, but
Right. So he came in, yeah, he came in a couple of weeks ago, and all of a sudden he pops up after years. Well, it was one meme that just got it started. Then it was the second where he shows his positions, and he has 120,000 of the June 21st 20 calls. Massive size for one individual. It's a massive size for an institution. For an individual, it's like over the top, right? And so when you look at that, I look at that position and it's a lot. I started looking at how much did he pay. So you can go back, look at some of the detailed data and see that he paid about somewhere between 550 and $6. I think they have it at about 583 or something like that. But it's somewhere there, because he bought, it looks like there was 70,000 bought on one day, but over the course of a few days before, a few days after, well, a few days before, because maybe a few days after, depending on when he actually released it. But he got the whole 120 at a certain price, and I think the questions that I'm seeing pop up in the communities revolve around what now? What will he do with that position? And I think that to clear things up, we probably should start from the beginning, just to go through it in detail, how someone would look at unusual option activity, and then get to the final, and then sort of talk about maybe a trade idea. What do you think?
perfect.
Yeah, that
Sounds
sounds
great.
good.
Okay, so what I noticed in 2021, especially with GME, was this increase in implied volatility. That, to me, that was most memorable because it's very difficult, or it's very rare to see stocks trade at 600, 700, 800 volatility, in 1 week, 2 week, and in 1 month up to 300, 400. This is enormous, enormous volatility. And an easy metric to understand what it means is just to divide the number by 16, and that would get you this estimated 1 day move for the stock that the market's anticipating. So if, for example, volatility of 16 divided by 16, that's 1%, or like an S&P type of thing in a normal, not in this environment, but a normal environment. 16 divided by 16 is 1% move per day. 32 vol, implied vol would be sort of an estimated 2% move per day. When you get something like 60, 70, 80 vol, you start getting close to 2.5%, 3%, so on and so forth. When you start getting to 300 vol, and you're dividing it by 16, 320 divided by 16 is 20% per day. So if you're a volatility trader, you're expected to make, it's really difficult to do. It's really difficult to do. That number is increased, making the premiums increase, making the ability for anyone who's buying options to make money on a directional or even a volatility basis very, very, very difficult. It's I would say it's not impossible because of course you can get the direction right, but really the odds are against you. And why does that happen? That happens basically because the market makers are there playing defense. So that's their way. It's like this: if you're in a battle and you're in a fight and you're throwing punches, the market makers' defense is to say, okay, well, you want to buy options? We're getting a little bit hurt here. You want to buy options? We're going to raise the premiums like crazy. And then we're going to widen out the bid offers. And so that by itself, if they want to make their money back and people are trading with wide bid offers and high 400, 500, 600 volatility, they're going to make a lot of money over those few days or however long they have it up there. So I always look at it and say, you want to be early. If you miss it, you really want to think about the strategy that you want to use. Buying options may be already a missed trade. It might not be the exact trade. Call spreads, put spreads also become